This is the visual that is haunting the algorithms this morning. It is an image that defies the laws of modern economics. If you look at the institutional terminals in London, the Bloomberg machines sitting on the desks at HSBC and Barclays, you will see a number that shouldn't exist. It is flashing red. Gold to silver ratio, 85-1. On paper, this number means that 1 ounce of gold is worth 85 ounces of silver. On paper, it means silver is cheap, abundant, and worthless. But if you take your eyes off the screen and look at the physical reality in the vault, that number is a lie. It is not a price. It is a crime scene. It is Sunday, February 8th, 2026. In New York, the Comex is closed. The lights are off. The paper traders are sleeping, confident that their short positions are safe. But in Shanghai, the market is wide open, and it is screaming. Right now, the Shanghai Gold Exchange is trading physical silver at $130 an ounce. But the futures price in New York, the ghost price that you see on your phone, it is stuck at 104. That is a $26 spread. That is an arbitrage gap so wide you could drive a truck through it. In a functioning economy, high-speed traders would close that gap in milliseconds. They would buy in New York and sell in Shanghai until the prices matched. But they aren't doing it. Why? Because they cannot get the metal out of New York. Because the 85-1 ratio is a paper fiction designed to keep you poor. We have received reports from the Port of Rotterdam and the bonded warehouses in Singapore. The flow of physical metal has stopped. The authorized participants, the banks allowed to redeem silver from the ETFs, are rejecting orders. They are quoting force majeure. They are claiming logistics delays. But we know the truth. We have the withdrawal receipts from the last 7 days. 33 million ounces of silver were removed from the Comex vaults in a single week. That is 26% of the entire registered inventory. Gone. Vanished. It didn't go to Apple. It didn't go to Tesla. It went to a sovereign entity that knows exactly what is about to happen next week. The West is trading a ghost. The East is cornering the reality. And the 85-1 ratio? It is about to collapse. Not because of market forces, but because of a law that goes into effect in exactly 7 days, a law that turns that paper contract in your portfolio into a worthless receipt and turns the physical metal in your safe into a kingmaker. Let's look at the document they tried to hide. While the world was distracted by the Super Bowl commercials and the noise of the political circus, a document was quietly uploaded to the Federal Register. It wasn't announced with a press conference. There was no breaking news alert on your phone. It was buried on page 412 of a seemingly boring regulatory update from the Office of the Comptroller of the Currency. But make no mistake, this is the kill switch. This is the financial nuclear weapon that the banking cartel has been terrified of for 50 years. We have obtained the leaked transcript of a private Zoom call that took place late last night between the heads of the 3 largest bullion banks in London and New York. The mood on the call wasn't panic, it was resignation. One CEO, a man who controls 40% of the global silver derivatives market, was heard saying, "On February 15th, the music stops. If we don't have the physical metal to cover the paper shorts, we go to jail." He wasn't speaking metaphorically. The new law, which goes into effect in exactly 1 week, is an amendment to the net stable funding ratio, specifically targeting unallocated precious metals. For decades, banks have been allowed to count paper silver that doesn't actually exist, as a Tier 1 asset. They could lease it, swap it, and rehypothecate it until a single ounce of real silver supported 500 ounces of paper claims. It was a Ponzi scheme sanctioned by the government. But the new rule changes one word in the tax code. It reclassifies unallocated silver from a zero-risk asset to a 100% risk asset. That sounds technical, but let me translate it into English for you. It means that starting next Monday, holding a paper short position on silver becomes expensive, prohibitively expensive. It means the banks have to hold dollar-for-dollar capital against every single paper ounce they claim to own. They cannot afford that. They are leveraged to the moon, so they have only one choice. They must close the shorts, they must buy back the paper contracts, and to do that, they need to find physical metal that simply is not there. This brings us to the villain of the story. You have seen the headlines about the Chinese billionaire who placed a massive $300 million bet against silver last week. The financial media told you he was shorting the market because he believed silver was going to crash. They called him a bear. They called him a gambler. They lied to you. We can now confirm that this billionaire is not betting against silver. He is an insider who switched sides. His short position was a spoof. It was a fake sell order designed to crash the paper price for exactly 48 hours. Why? Because he needed to trigger your stop losses. He needed you to panic. He needed the price to dip just low enough so that his agents in London and Zurich could sweep the physical vaults clean at a discount. While you were selling your SLV shares in terror, he was taking delivery of 4,000 metric tons of physical bars. He knows about the February 15th law. He knows that once that rule kicks in, the paper market will be forced to converge with the physical market. He knows that the 85-to-1 ratio is going to snap back to 15-to-1, maybe even lower. He didn't short the market to make money. He shorted the market to steal your silver before the revaluation event. This is the narcissistic collapse of the US dollar happening in real time. The Federal Reserve has realized that they can print infinite currency, but they cannot print infinite trust. The world has stopped trusting the paper price. The central banks of the BRICS nations, Brazil, Russia, India, China, South Africa, have stopped buying treasuries. They are dumping the dollar and buying the only asset that has no counterparty risk. And they are doing it right now, in the shadow of this new law, before the public wakes up. The psychological disintegration inside the West Wing is palpable. Sources describe a Treasury Secretary who is paralyzed. They know that if they enforce the law on February 15th, the Comex collapses. But if they don't enforce it, the rest of the world will abandon the dollar immediately. They are trapped in a checkmate scenario. They have to sacrifice the bullion banks to save the currency. And the banks know they are being sacrificed. That is why the sold-out signs are popping up on every dealer website. That is why the premiums are exploding. The banks are hoarding the metal for themselves. They are preparing for the force majeure declaration that will cancel your contracts and leave you with a check for a worthless amount of fiat currency. The billionaire won. The banks are folding. And the law is the guillotine blade that falls in 7 days. But there is a deeper force at play here. A force stronger than laws and stronger than billionaires. It is the geology itself. In the next section, we are going to look at why even a price of $1,000 cannot create more silver. We are going to dig into the byproduct paradox and show you why the Earth has finally stopped negotiating with Wall Street. You might be thinking that if silver goes to $1,000, the market will fix itself. You have been taught that high prices create new supply. You have been taught that if the price goes up, the miners will dig faster, the refineries will work harder, and the shortage will vanish. That is the greatest lie in economics. It assumes that silver is like wheat or corn. It assumes you can just plant more acres next season. But you cannot plant silver. You cannot print silver. You have to find it. And here is the terrifying truth that Wall Street is ignoring. We have already found it all. This brings us to the geological revenge. It is a concept known as the byproduct paradox. 70% of the world's silver does not come from silver mines. It comes as an accidental byproduct of mining for copper, lead, and zinc. A copper miner in Chile does not care about the price of silver. He cares about the price of copper. If the global economy slows down and demand for copper falls, he shuts down the mine. It doesn't matter if silver is trading at $500 or $5,000. If the copper mine closes, the silver supply disappears. The price of silver has zero influence on 70% of the production. The supply is inelastic. It does not respond to price signals. It only responds to geology. And the geology is failing. The ore grades are collapsing. We are moving mountains of earth just to find microscopic grams of metal. It is a battle against thermodynamics, and we are losing. Inside the boardrooms of the world's largest technology companies, this realization has turned into panic. We have reports that emergency meetings are being held at Tesla in Austin and Samsung in Seoul. They aren't looking at the price charts. They are looking at their production schedules. They know that without silver, there are no electric vehicles. Without silver, there are no solar panels. Without silver, the entire green energy transition grinds to a halt. For years, these companies bought paper futures to hedge their costs. They thought they were safe. But now they realize that a paper contract cannot be melted down to make a circuit board. You cannot solder a chip with a promise. So they are bypassing the Comex entirely. They are doing what the Chinese billionaire did. They are calling the miners directly. They are trying to buy the mine. They are trying to verticalize the supply chain because they know that in a week, the open market will be dry. Let's look at the math of the reversion. This is the calculation that proves the millionaire status of the stacker. Throughout history, the ratio of gold to silver in the Earth's crust is roughly 8-1. For every 8 ounces of silver we find 1 ounce of gold. That is the geological constant. But the financial ratio is 85-1. That is a manipulation. That is a distortion caused by paper leverage. When the paper market breaks on February 15th, the ratio will not just correct, it will snap back to the geological reality. Let's do the math together. If gold revalues to $15,000 an ounce to back the global money supply, which is a conservative estimate given the debt levels, and the ratio returns to 8-1, what is the price of silver? 15,000 divided by 8 is $1,875 an ounce. That is not a bubble. That is not a squeeze. That is fair value. That is simply silver returning to its natural state as monetary mass. The elastic band has been stretched for 50 years. The banks use paper to pull it further and further away from reality. But geology is the anchor, and the Earth does not negotiate with the Federal Reserve. The Earth does not care about the US dollar index. The Earth only yields what it has, and right now it has nothing left to give at these prices. The trap is absolute. The industrial users must buy at any price to stay in business. The investors must buy at any price to preserve their wealth. And the miners cannot produce a single ounce more than they already are. This is the definition of a singularity, a point where the rules of economics break down and the price becomes infinite against a dying currency. In the final section, we are going to talk about the psychology of the new elite, because when your net worth explodes overnight, the danger doesn't end. It changes. We are going to discuss the Monday morning scenario and exactly how to protect yourself when you become the target. God help us all if you sell too soon. We are about to witness the birth of a new class system and the death of an old one. The history books will call it the Great Revaluation, but psychologists will call it the narcissistic collapse of the paper aristocracy. For 40 years, the wealth of the world has been defined by digits on a screen. The man with the biggest stock portfolio, the woman with the most bonds, the pension fund with the highest yield, they were the kings and queens of the debt age. They believed their wealth was real because the screen told them it was real. They looked down on the physical world. They laughed at the gold bug. They mocked the silver stacker as a paranoid relic of the past. But on Monday morning, February 16th, the day after the law takes effect, their reign ends. Imagine the psychological disintegration of a millionaire who wakes up to find that his bank has bailed in his deposits, his bond portfolio has lost 80% of its purchasing power, and his tech stocks are halted. He is still a millionaire on paper. The digits are still there, but he cannot buy a loaf of bread. He cannot buy fuel. He cannot buy safety. He is an exiled aristocrat holding a title to a kingdom that no longer exists. And then there is you, the ignored class. The silent observer who bought silver when it was $20, the one who stacked monster boxes in the back of the closet while your friends bought NFTs. You are about to become the new elite, but I must warn you, this transition will not be a victory parade. It will be dangerous. When the price of silver hits $1,000 and then keeps going to match the geological reality of 1,875, you will feel an urge to scream, "I told you so." You will want to tell your neighbors. You will want to post a screenshot of your portfolio on social media. Do not do it. You must adopt the gray rock method of wealth preservation. In psychology, the gray rock method is how you deal with a psychopath. You become boring. You become uninteresting. You become a rock. You do not engage. You do not brag. You disappear. Because when the masses realize that their paper money is dead, they will be looking for someone to blame. And they will be looking for someone who has what they need. If you flaunt your silver, you become a target. You become the bank in a world of bank robbers. The smartest move you can make when your net worth explodes is to say nothing. Act poor. Complain about inflation like everyone else, and quietly, secretly, secure your future. Now, let me tell you exactly what Monday morning looks like. This is the scenario that the algorithms are trying to price in right now. The market opens at 9:30 a.m. You look at the screen, you see a bid price of $1,000. That means there are buyers lined up around the block willing to pay $1,000 for an ounce of silver. But then you look at the ask price. The ask price is blank. It says no offer. Do you understand what no offer means? It means no one is selling. It means the price has gone to infinity. It means the currency has failed. In that moment, you will be tempted to sell. You will see a number that looks like a fortune in dollars. But you must remember why you bought the silver in the first place. You didn't buy it to get more dollars. You bought it to get away from dollars. If you sell your silver for $1 million and a loaf of bread costs $10,000, you haven't made a profit. You have just exchanged real money for the very thing that is collapsing. The end game is not to sell your silver. The end game is to borrow against it. The end game is to use it as collateral to buy productive assets, farmland, businesses, real estate at the bottom of the crash. The old aristocracy will be selling their assets for pennies to buy food. You, the new aristocracy, will be the only ones with the liquidity to buy them. This is the cycle of history. It happened in Rome. It happened in Weimar, Germany. It happened in Venezuela. And now, thanks to the mathematical inevitability of the 85-to-1 collapse, it is happening here. The law is signed. The date is set. The earth is empty. And the paper is burning. You have 7 days, not to trade, not to gamble, but to position yourself on the right side of the fence. Because when the bell rings on February 16th, there will be no more offers. There will only be those who have it and those who weep. God help us all.